For the big story this evening, the results of the stress tests of the top 19 American banks will be out later tonight. The tests are intended to check the vulnerability of banks and shore up capital. On What's Hot Tonight, we ask, how do these tests strengthen the US banking system? Joining us, Charles Ortel, Managing Partner of Newport Value Partners. Charles is in India and joins us from our Bangalore studios. Before I begin, come to you, Charles, let's just play out what Bernanke has just said. He's brushed off all criticism that the stress tests weren't stressful enough.
We looked at all the portfolios and as well as reserves and earnings projections for all 19 firms, which meant that this was extraordinarily comprehensive, extraordinarily detailed and intensive work. And it had the additional advantage that we were able to use results across the system to benchmark and compare the reasonableness of the results for each institution. So in looking at a mortgage portfolio for institution A, we not only looked at their own estimates and our own work on projected losses, but we were able to compare it with similar portfolios across the system. And so there's a greater level of consistency here and comparability than in anything that's ever been done before.
Charles, let me ask you first, Bernanke calls this comprehensive test. What's your view on the test per se? More importantly, these tests don't seem to do anything about the underlying problem of those over $1 trillion toxic assets, don't they?
Yes, of course the devil here will lie in the details. I mean, what we have is a broad set of overview comments this evening, Indian time, which I've just had the pleasure of listening to. I await with keen interest seeing the actual details concerning the banks that were tested. But I have a hierarchy of concerns here. I mean, the first is, are these 19 banks truly representative of the wider set of problems that we may face in the United States, for starters? How truly rigorous were these tests? Was there a one-size-fits-all approach to thinking about each bank, or did they really dive in great depth and treat each bank separately? I think we have to remember that the team that was doing this work is largely the same team that missed the problems as of June 30th, 2008. So, I count myself for the moment as a skeptic who's willing to be convinced once I see the deep details that should come out shortly.
Right, Charles, let me bring to attention another comment by Ben Bernanke, and he said earlier this week that he was hopeful that banks should be able to raise capital on their own rather than having to rely on government for aid, and he also added that no bank will be allowed to fail. Now, how easy is it actually going to be? Because it seems suddenly like in the last 6 months things have changed so dramatically that it's going to be very, very easy for banks to actually go out there and raise capital at this point.
I think it's a very tough job. I mean, if you think about the American banking system, it changed radically in the last decade, and it reached a point where a series of very bad loans were made across the spectrum of the economy. The rules seem to be changing almost on a weekly basis here, and as you think about putting money in as a private person into the banking system, you have to ask yourself, what do you think it's going to look like next week, next month, next year? And with all these changes, it's very tough to tell. Another problem I see here is that there's a large number of banks looking for money at the same time. So it must be tough for any one of them to make a better case than another that you ought to give them their money. A third problem I see here is that it's not as if the United States government has been putting hard equity into these banks. We've been borrowing money from abroad to make these risky equity investments. So I really think what we need in the U.S. banking system is more hard equity going in. We need some rationalization. I think some of these banks are going to have to be combined. And I also think we need a new system of regulation. We can't have a system where on the way up, managers do really well and collect bonuses, and on the way down, it's the taxpayers who fund the problems. That's a misalignment of incentives and punishments.
Right. We've seen some changes, Charles, with regards to accounting standards as far as mark-to-market is concerned, and that really seems to have, aided sentiment in favor of banking stocks at this point in time. The bet really is that if the economy does recover, the banks will get back on their feet. But if it doesn't, will it actually mean more subsidies? Will it mean more government intervention? The Obama administration doesn't want to go back to the taxpayers, but do you think they will have to?
I think they may well have to. I mean, the simplest way to think about this complex problem is to understand that in the United States, the biggest element in the balance sheet of the United States is residential real estate. And after that comes investment in securities and in commercial real estate. Residential real estate prices were pushed into the stratosphere in the United States, well above the levels that incomes could support the mortgages on these homes. And until we see some real bottoming in the residential real estate market, I think we're well away from wanting to be optimistic in the U.S. The second shoe that really hasn't dropped yet is the commercial real estate side. We've had some anecdotal tales, but the owners of commercial real estate can hang on for a while. And I think we're closer now to a point where these commercial real estate loans are going to have to be refinanced at a bad time. So I personally, I count myself as an optimist, but I like to look at hard facts, and the hard facts I look at don't support an optimistic view at this moment in time yet.
Charles, we've seen all kinds of numbers being thrown at in terms of the capital shortfall of these banks. What's your own view? Will banks need this kind of money? And B, today we've seen Tim Geithner talk about in one of the newspapers that he expects nearly $25 billion of those rescue fund money to be returned back to the government. Is that a possibility, you think?
Well, certainly I think the government will begin to see some modest returns from these banks, but the scale of our problems is truly monumental. The values that we're talking about, the total balance sheet in the U.S. is in the tens of trillions of dollars. So elements of some of these balance sheet entries, as I mentioned, the residential and commercial side, are huge. You have a 10% price change in the value of all residential real estate. You have a massive hole. So I think it really is too soon to tell. We have, in the results coming out, we're only just now getting results as of March 31st, 2009 for some of these filers. A lot of the filings are run to the hundreds of pages long. It's going to take time for experienced people to really look through them. In the United States, the people who are closest to the fine detail on the financial system are Meredith Whitney and people like Nouriel Roubini, who continue to be very, very negative. So I think this is just an opening salvo. We're going to see later today, we'll see some of the detail, and then it's going to take several days to digest it. Then we're going to have to start looking at are there truly signs of life away from the banking system? Are we seeing consumption return? Are we seeing real investments being made in the private sector, not in the public sector? Until we see that kind of data, I don't really think it's the time to roar with optimism.
Charles Ortel, many thanks for joining us with that perspective. Well, let's wait and watch the results of those stress tests that are expected later tonight. We get